In this video, we're going to discuss cash concentration. So basically, large companies might have many subsidiaries. Now, many subsidiaries might mean that there are many bank accounts. Because there are many bank accounts, your cash will be fragmented at different places. Now, this is inefficient. It is more efficient if these fragmented account balances, which are in many accounts, can be pooled into one account, which is called cash concentration. Now, cash concentration can be done in through two ways. One is your physical sweeping, and the other way to do that is notional pooling. We will discuss both of these later on. Right now, we're going to go into the advantages of cash concentration. So why is it better, instead of having multiple accounts, to have one account where all of the cash of the business is managed? Advantage number one is that eliminates idle cash. So once you have cash at one place, you can utilize that cash better. The second advantage is improved investment returns. Now, again, because you have cash at one place, you can easily divide that cash into short-term investments and long-term investments. If you have many subsidiaries, then you might be worried if you invest too much into long-term investment, then maybe you'll run out of cash. But once you have concentrated all of your accounts, you will have a good idea of how much cash is extra that can be invested in long-term investment, which will give you a higher yielding return. Then more cost-effective oversight of accounts. Of course, instead of having multiple accounts, if you have one account, then that would mean that the labor is reduced and the cost of managing it has reduced. Internal funding of debit balances. Now, usually the subsidiaries might have taken a bank overdraft, although they would not have required that bank overdraft because it could have been covered by another subsidiary's positive cash balance. So instead, in order to avoid these unnecessary expenses, cash concentration will be very feasible. Now, let's look at an example to understand this even more. So over here you have two examples. Number one is scenario without cash concentration, and you can see that there are four subsidiaries. So subsidiary 1, 2, 3, and 4. And the overdraft interest rate is 8%. The credit balance interest rate is 3%. The cash balance in each account. So subsidiary 1 has a cash account balance of positive 100,000. Now, because it's a positive balance, they will get the 3% credit balance rate on it. So this 3,000 is simply 100,000 multiplied by 3%. Now the second one, you can see the subsidiary 2 has an overdraft of 50,000. The bracket means a negative balance. So there is an overdraft of 50,000. So they will have to pay the overdraft interest rate of 8%. So they will have to pay the 8% interest rate and negative 4,000 amount. And so on. You have 35,000 and 75,000. Adding all of this up, the business actually has a 90,000 positive cash balance, yet they have to pay 1,550 in interest amount in overdraft charges. Instead of that, it would have been more feasible if they would have merged all of their accounts. Over here you can see, because you have used cash concentration, each of the subsidiaries do not have their own separate balances. Instead of that, you have merged all of the balance and you have this 90,000 total over here. Now this is a positive amount, and this 8%, this 3% credit balance rate will be applied on this, and you will have a positive amount. So if from scenario 1, in which you were taking an overdraft, you have actually gone into a positive interest income simply by merging all of your account balances, because now you don't have to take the overdraft from the bank. Instead of that, you're using your positive cash balances of 100,000 and 75,000 to pay for these two overdrafts of subsidiary 2 and subsidiary 3. So you can see that cash concentration is very beneficial for large organizations who can use this technique, who have a treasury department to do so. Like already discussed, cash concentration requires that you create a cash pool. There are two ways of doing so. You can do it through physical sweeping or you could do it from notional pooling. In physical sweeping, funds they actually physically flow from the subsidiary accounts into one concentration account. So the cash balances they actually move into one account. Whereas in notional pooling, the cash balances in the subsidiary accounts can be concentrated in the master account only within the bank's records, whilst the cash remaining in the subsidiary accounts. So in notional pooling, you just pool the records that okay the cash is at one place, but you do not physically move the cash into one bank account, and you make sure that it remains in the subsidiary accounts. So now we're going to see how is this physical sweeping done. So basically in physical sweeping, a zero account balance is maintained. So the bank will automatically move cash from the different accounts into the concentration account. Let's see how it is done through an example. I'm just going to zoom this in. So over here you can see concentration account, you have a zero initial balance and the local bank account A has 10,000. Then the local bank account B has 25,000 and the local bank account C has a negative 5,000 balance. Now what will happen first is that the positive account balances will be shifted to the concentration account. So the local bank account 10,000 balance and the 25,000 balance has been shifted to the concentration account. The negative balance is not yet shifted. Once you have money in the concentration account, you're going to shift the amount from the concentration account now in the local bank account C in order to finish off that negative balance. So you had 35,000 here, you have shifted the 5,000 into the bank account C, and over here also you have a $0 balance now. Okay. Now over here, there are two things. One is constant balancing and the other is trigger balances. Constant balancing is instead of maintaining a zero balance, you're going to maintain a minimum balance in your account. So you will not turn them into zero. Instead of that, you're going to maintain a minimum balance because practically there should be some cash left with your subsidiaries as well in order for them to make small payments. You cannot shift the whole balance. So constant balancing means that you keep a minimum benchmark, and only once your amount exceeds that minimum balance, then you shift that extra amount into your concentration account. Okay, and similarly, you can even have a level. So the minimum is telling you that this much amount has to be in the bank account. Similarly, you can even have a trigger balance. The trigger balance is going to be that amount at which the sweep will occur. So you might decide that once it reaches $10,000, the sweep will occur, whereas the constant balancing, the minimum balance might be 2,000. So the trigger is the amount at which the transaction will just automatically happen. So any amount above that will be transferred to the concentration account. The constant balancing and trigger balances, the both of them will help in automation of the system because you want sweeping to be fully automated so that it involves less manual tracking and less errors. In notional pooling, we discussed that the accounts are in the record, they are concentrated in one account, but there is no physically transfer of cash funds into one account. Now, what that makes possible is that the business has a centralized liquidity position but it still retains daily cash management privileges. So all the accounts are merged into one centralized account, and then the interest is calculated. So the asset management is done through a centralized position, whereas for the daily cash expenses, the subsidiaries will still have cash in their account balances. So compared to notional pooling and account sweeping, actually notional pooling is preferred because of the advantages that it offers over your account sweeping methodology. For example, there is no need to create or monitor intercompany loans in notional pooling because the subsidiaries still have their own balances. They can pay their loans on their own. There is no bank fees related to cash transfer because in the when the actual cash is transferring from one account to the concentrated account and then from there back, so there's a lot of cash transfer involved and unnecessary expenses. It eliminates the need to arrange overdraft lines with local banks because if there is overdraft is required, then you still have the centralized cash position to take care of that. And it is also not a long term commitment. So if you want to get out of the notional pooling at any point in time, you can do so. However, the disadvantage is that in a lot of countries it is not allowed.